Today I'll begin my economic outlook with a brief summary of Federal Reserve Chair Janet Yellen's semi-annual monetary policy report. I will then briefly discuss the California economy, as well as 3 provisions favorable to the real estate sector included in a huge year-end budget bill passed by both houses of Congress and signed by the President. The economy has made further progress, according to Chair Yellen, toward the Fed's objective of maximum sustainable employment. Inflation is expected to remain low in the near term, in part because of further declines in energy prices. But inflation will rise to its 2% objective over the intermediate to long term. Since the trough in 2010, more than 13 million jobs have been added, and the unemployment rate dropped to 4.9% in January 2016. Gross domestic product in 2015 expanded by 1.75%. Growth slowed towards the end of 2015 and into 2016 because the strong dollar was holding back trade and inventory expansions. Household spending was supported by solid growth in real disposable income, in part because of declining oil prices. U.S. auto sales set a record in 2015 with over 71 million vehicles sold, largely because of gains in the economy, higher consumer confidence, and interest rates at historic lows. In my last economic outlook, I said it was more likely than not that the Fed would raise interest rates in December, but I didn't think they should. The performance of economies abroad and the strength of the U.S. dollar are very adverse conditions to increasing domestic product through trade. And I think, therefore, there's no reason to raise interest rates at this point. Now let's look at California. California's $2.3 trillion economy added 64,000 employees in December 2015. It added jobs for all of 2015 at a rate of 2.9%. That is much faster than the 1.9% growth nationwide. Growth came from a variety of sectors: construction, trade, tourism, technology, agriculture, entertainment, and healthcare. The Foreign Investment in Real Estate Tax Act of 1980, known as FIRPTA, imposed federal tax obligations on most non-U.S. investors with respect to capital gains. At the end of 2015, both houses of Congress approved and the President signed a bill named Protecting Americans from Tax Hikes. So what this does is now make it clear that a foreign pension fund investor can invest in the United States without any tax liability that was imposed by FIRPTA. And this will release billions of dollars of foreign investment for the real estate sector. Based on the current economic conditions, I'm very positive about the U.S. and California economies for the balance of 2016.